Morgan Stanley just handed CVX as Chevron an overweight rating and a $212 price target, about 15% above where the stock was trading when the note landed. That number matters less than the reason Morgan Stanley gave for it, because the reason exposes a fault line running through every oil major right now. The prior bull thesis on oil equities was straightforward. A Hormuz supply shock lifts crude. Crude lifts producer cash flows, and majors with production leverage win the most. CVX's first quarter appeared to confirm it. Production up 15% year over year, U.S. output up 24%, $6 billion returned to shareholders. But the stocks fell anyway. The group dropped roughly 8% month to date against a 9% decline in oil prices, underperforming the broader market by about 10 percentage points. That divergence tells you the market is no longer pricing oil equities as simple crude price proxies. What Morgan Stanley actually rewarded CVX for was the absence of a decision, unchanged 2026 production guidance, unchanged capital spending of $18 to $19 billion. The companies that announced higher activity or raised CapEx got sold, with Diamondback, ConocoPhillips, and Permian Resources all cited as examples of the penalty trade. So the capital discipline story is real, but it is also a defensive posture masquerading as a catalyst, and that reframing matters for what CVX's overweight actually prices in. The 15% upside implied by Morgan Stanley's target assumes the Hormuz disruption resolves without destroying the demand side of the equation that justifies those production volumes. CVX's limited Middle East exposure was flagged explicitly as a structural advantage over peers, but limited exposure to the supply disruption is not the same as immunity to what the disruption does to global demand. XOM, by contrast, quantified a 750,000 barrel per day production impact if the Strait stays closed for a full quarter, with second quarter output guided to 4.1 to 4.3 million barrels of oil equivalent per day under that scenario. Morgan Stanley still sees 15% upside to XOM's consensus EPS from refining and chemicals margins, but the production hit forces a different valuation conversation than the clean CVX narrative allows. The asymmetry between the two majors is not just about geography, it is about which risk class each stock is now absorbing. CVX has shifted from a crude leverage play to a capital discipline story, and that shift only holds if the demand environment that underwrites its production outlook stays intact. Whether it does depends on a chain of events that Morgan Stanley's note does not fully price, and that chain starts with how long the Hormuz closure actually lasts.
JPMorgan's analysis is the countersignal that Morgan Stanley's overweight does not account for, because it reframes the Hormuz disruption not as a supply shock that lifts oil prices, but as an inflation shock that constrains the demand for oil. The distinction sounds subtle, but it determines whether CVX's production volumes find buyers at prices that justify the $212 target. JPMorgan warned that Brent could spike to 120 to 130 near term, with an overshoot toward 150 if the Strait stays closed, and global supply disruptions already reached 13.7 million barrels per day in April, roughly 14% of total world demand. Inventories are drawing at 7.1 million barrels per day, and the market is still short by an estimated 2 million barrels per day even after that extraordinary drawdown. The counterintuitive element here is that higher crude prices are not straightforwardly good for CVX's equity value in this environment. JPMorgan maps 3 scenarios, and across all of them the Federal Reserve stays on hold well into 2027, meaning the rate cut cycle that would normally re-rate energy equities higher is effectively canceled by the inflation the supply shock creates. Energy-driven inflation is particularly resistant to rate policy because it originates outside the domestic economy, so the Fed faces a choice between tolerating above-target inflation or tightening into a supply-constraint slowdown. Either path suppresses the demand growth that CVX's unchanged production outlook of 3.98 to 4.10 million barrels of oil equivalent per day requires to generate the cash flows Morgan Stanley models. In JPMorgan's worst case, headline CPI moves above 5% and stays there, at which point industrial energy demand contracts. The same consumers who are paying $4.05 per gallon for gasoline pull back on discretionary spending, and the demand base that supports $120 crude begins to erode from below. That is the demand destruction loop. The supply shock creates the price spike creates the inflation destroys the demand that would otherwise absorb the supply. CVX's beta to crude prices does not distinguish between a supply-driven price rise that expands producer margins and a demand destruction price collapse that follows the inflation peak. The risk structure of holding CVX has changed. The upside and the downside now depend on the same variable, duration of the Hormuz closure, but they run in opposite directions depending on which phase of the shock the market is in. A short closure resolves in CVX's favor. A prolonged closure that pushes inflation above 5% restructures the demand environment that the overweight thesis requires. What the Morgan Stanley note leaves unresolved is where exactly that inflection point sits, and the IEA supply data suggests the market may reach it faster than the $212 target implies.
The IEA warning that global supply will fall below demand and remain severely undersupplied through October, even if the conflict ends next month, is the fact that reprices CVX regardless of how the diplomacy resolves. On May 20th, crude prices slipped after President Trump said he had called off a strike on Iran, and that diplomacy appeared to be making progress, with Iran described as being reasonable. That price move reveals how the market is currently positioning. It is treating a negotiated resolution as the base case and discounting the supply shock accordingly. But the IEA's number cuts through that optimism directly. 4 million barrels per day of inventory drawdown in March and April, and the Goldman Sachs estimate that nearly 500 million barrels have already been pulled from global stockpiles, potentially reaching 1 billion barrels by June. Goldman Sachs also estimates that Persian Gulf crude output has been curtailed by roughly 14.5 million barrels per day, with local storage reaching capacity, forcing producers to cut output by about 6%. The infrastructure damage is the overlooked variable. The IEA reported that more than 80 energy facilities have been damaged, with recovery potentially taking up to 2 years. That 2-year figure means the supply restoration timeline does not track the diplomatic timeline. A ceasefire does not restore the 14.5 million barrels per day that Goldman has mapped as curtailed. For CVX, this creates a conditional upside structure, a diplomatic resolution that reduces the demand destruction risk JPMorgan identified, while leaving the supply deficit intact is the scenario where the Morgan Stanley $212 target becomes reachable. The counter condition is a resolution that arrives too late, after JPMorgan's inventory stress threshold hits operational minimums as early as June, triggering the demand destruction loop before the supply side recovers. OPEC's stated intention to continue quota increases through September introduces a partial offset, but spare capacity from Saudi Arabia and the UAE is effectively offline as long as the Strait remains closed. The asymmetry of those two paths, diplomatic resolution before June inventory stress versus after, is the specific threshold that resolves whether CVX's risk structure tilts toward the overweight or toward a repricing of the entire bull thesis. Morgan Stanley's $212 target, JPMorgan's Fed on hold through 2027 scenario, and the IEA's October undersupply horizon all converge on the same binary. Does the Strait open before the demand base breaks? That question was unanswered when the overweight was issued, and the diplomatic signals of May 20 shifted the probability distribution but did not resolve it. CVX's capital discipline story survives either scenario in the short run, but the production volumes that underpin the 15% upside only convert to cash flow if the demand environment holds long enough for the Tengiz-Chevron oil expansion and Gulf of America ramp-ups to reach full output. The verification benchmark is not the oil price itself. It is whether OECD inventory stabilized before hitting the operational minimum that JPMorgan flagged as the June stress threshold. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.